all can be true. Good afternoon, everyone. Welcome to our quarterly pension board meeting. Chris Hoffman, acting chair. Call this meeting to order. We'll begin with, we'll do the oath of office first.
Oath of office has been completed.
The oath of office has been completed. That was quick. Madam Clerk, roll call.
Nick Curry.
Here.
Dan Jansen. Christine Hoffman.
Here.
Brendan Marisma. Eddie Vergara.
Here.
David Cohill.
Here.
John Patridge.
Here.
Matthew Grocke. John Gottstilla.
Here.
Jason Sharp.
Here.
George Candler.
Here.
Ed Dawson. John McDaniel.
Here.
Lance Hewish.
Here.
Debbie White.
We have a quorum for all three boards. Great news. We'll move on to approval of minutes. There was one Scrivener's error noted that the start time was indicated as 3 p.m. It was actually 1 p.m. That was a nice long meeting last time. I don't think this one will be quite as long. Can I have a motion for approval? In a second? Do we do this one by board? From the firefighters, since they already did it. Firefighters, all in favor signify by saying aye.
Aye.
Any opposed? Please. Have a motion?
Motion made. Second.
All in favor signify by saying aye.
Aye.
Any opposed? Motion carries. General board or general employees board?
Motion made.
Do we have a second?
Second.
All in favor signify by saying aye.
Aye.
Any opposed? Motion carries. No. I'm sorry. I missed courtesy of the floor to visitors. Do we have any visitors that would like to speak? Seeing none. What would you like to speak?
I'm just a nursing student, and I was required to be here.
Tell us more. So, what? Can you give us your name?
So, my name is Ashlyn.
Ashlyn?
I'm in a community health nursing class right now, and so we've been assigned the Jacksonville Beach zip code to go around and kind of just observe the area, and then we were required to come to a meeting too. So that's fine.
And of all the meetings, you picked pension board?
I'm doing it last minute.
There it is. Well, Ashlyn, welcome. Where are you a student? JU, congratulations. How far into nursing are you? You'll be done in May? Oh my gosh, right around the corner. Congratulations. Are you Jacks Beach resident?
I am.
Okay, great. Well, this is your pension board at work. Yeah. Well, thank you for being here. I hope you find it interesting. Okay, so courtesy for approval of minutes, new business consideration by General Employees Board of Trustees. We have an application for retirement, Ronald Curtis, Facilities Maintenance Manager, effective 9/1/2025, separation date 8/31/2025, meets age and service requirements for normal retirement at 15 years and 7 months of service. Is there a motion from General?
Second.
We have a motion and a second. Madam Clerk, roll call.
Nick Curry.
Yes.
Christine Hoffman.
Yes.
Eddie Vergara.
Yes.
Motion carries. Police Officers Board, we have approval for the application for retirement from Anthony Bennick, Police Corporal, effective 9/1/25, separation date 12/29/2010, meets age service requirements for vested retirement, 11 years and 11 months of service. Do we have a motion?
Motion. Second.
We have a motion and a second. Madam Clerk, roll call.
David Cohill.
Yes.
John Patridge.
Yes.
John Gottstilla.
Yes.
Jason Sharp.
Yes.
Retirement approved. Moving on to item C, consultant reports. Brendan Mariner.
Good afternoon, everyone. So we've got a lot of materials. I know you said this would be a quick meeting, but maybe not so fast. Quicker enough. Hopefully we'll be able to move through reasonably quickly. So for the first two items, we have the June 30th quarterly book as well as the July 31st flash. You have those as separate hard copies in front of you. We'll go through those first. And then the other three items are all kind of tucked together within your agenda packet. So we'll start to go through those once we get there. So first, we'll jump into the June 30th book. And page number 1, am I doing this right? We do have a couple of new pages that you kind of haven't really seen before. So this is the first quarter end that is 1 year fully removed from our merger with Mariner. So we have a couple of pages that are kind of one-offs that aren't typically in the book. The first part on the top of that page number 1, actually this is something you probably heard of in the past, but there's an organization out there called Coalition Greenwich, and what they do is they survey institutional clients, and based on the results of those surveys, they hand out awards, and they're obviously meant for institutional consultants. And for the 4th consecutive year, ANCO/Mariner has earned the Best Investment Consultant Award. So we just kind of wanted to place a little bit of an advertisement in there for you on that part of the notice there. The bottom half of page number 1 gets into kind of really the proof statement of what we said a little over a year ago when we were merging. ANCO was becoming part of Mariner. We said it was going to be the same people, really the same organization, just being relabeled Mariner Institutional. And we were going to be serving the same clients. So the kind of the proof statement down the bottom: over 99% client retention, over 99% employee retention. Kind of, again, exactly what we had stated, same people doing the same thing for the same types of organizations. The next page just briefly talks about kind of the 2 main service areas. So on the left-hand side is traditional plan services, what we do for you within kind of the defined benefit world. And then we also have defined contribution services. So there are a lot of defined benefit plans that don't really understand the defined contribution side. So we just kind of put that there, or vice versa. If we're doing defined contribution work for a system, they might not understand the defined benefit side. So we just kind of laid those 2 things out there. And then the last page there, or the next page, is just sort of a little advertisement. The change is obviously being part of Mariner. The parent or broader Mariner is individual wealth planning. So we just kind of bullet point a few of those different individualized services. But again, those are not applicable to institutional pension funds.
This Best Investment Consultant, is that in the U.S. or in Florida? Or?
U.S., yes.
It's impressive.
Thank you. So if we turn to page number 7, now's where we kind of get into the broader market review. I hope everyone's been wearing their seatbelt for the last 9 months, because it has been an incredibly volatile ride. But the good news is the last quarter was essentially nothing but up. So if you look in the upper right-hand corner of page number 7, you'll see the major asset classes where we're invested. The kind of gray or blue bars at the top represent domestic stocks, and they were all up, call it 10 to 11%, with the exception of small and mid cap was up about 8.5%, but very strong numbers. International, those kind of yellow bars, were up somewhere in the neighborhood of 12%. And what's I found a little surprising, when you look at the red bars or pink fixed income, they were also positive for the quarter. Typically, when you're having double-digit type equity returns, it's usually at the expense of fixed income, right? We're selling fixed to buy equity, or vice versa. If equity's down, usually fixed income is up. We're selling equity to buy fixed. But in this particular quarter, we actually saw all of those major asset classes going higher, which obviously, considering that's the vast majority of your plan, that means everything generally was moving in a positive direction, which is obviously very good. The only other thing that I wanted to draw your attention to on the next page, when you kind of lift up the hood and look at the equity markets, notice the difference between the blue bars, which are value stocks, and the red bars, which represent growth stocks. For the quarter, growth was up almost 18% just in 3 months. Value was up about 4%. Now, I'm sure you remember last quarter, growth was negative 10 and value was positive 2. So just an incredible kind of flip-flop and deviation from one quarter to the next in terms of those relative returns. And obviously, we're not trying to take bets or positions. We have both a value manager and a growth manager, but it's just interesting to see that level of a performance gap between those two different parts of the market. I'm going to skip the next handful of pages and then just very briefly touch on fixed income, which is on page 14. I'm down in the bottom right-hand corner. And really what we're focusing on is the difference between the blue bar and the orange bar, which is where we were 3 months ago. What's somewhat unusual, if you look in the middle part of that graph, from about the 1 year out to the 10 year, is the blue line fell, dropped below the yellow line. So interest rates were falling in what we call the belly of the curve, or the middle part of the curve. But on the right-hand side, it actually, the longer end of the curve, we actually saw rates rise. So there's sort of a little bit of a split there happening between long rates and kind of short and mid rates. But since the majority of the fixed income market is in kind of the middle of the curve, and that's where also our portfolio is predominantly, that fall in interest rates is what led to that positive return that we saw in the broad fixed income market. Just kind of wanted to provide a little bit more context there because it's somewhat unusual. Typically, you get kind of that entire line moving higher or lower than the previous quarter, and here we had a little bit of a split. So with that, now let's jump into the actual plan. Page 17, I can't skip this one. Total plan assets as of June 30th up to $134.4 million. Again, we compare that to that theoretical assumed rate of return line, which would have had you at $113.8 million. So a nice incremental gain over that, assumed rate of return. And then the other thing we show down along the bottom is your net cash flow. We always talk about this. Your net cash flow going all the way back to 1987 now stands at a negative $39.2 million. So in other words, since 1987, you pulled out all 11.8 million that you had in the plan, plus an additional almost $40 million. Yet you've still been able to grow your assets up to $134 million. So what graphically that's showing you is we're growing the assets at a faster rate than you're paying out what we call negative cash flow. More going out in payments than is coming in contributions, and we're still able to grow the asset above and beyond that rate that you're paying out. All right, so the next couple pages get into the asset allocation. I'm gonna skip to page 20 and just look at those differences in the allocation relative to our investment policy. And what you'll notice is equity in total, when you combine both domestic and international, is really spot on target. Slightly under in domestic, but slightly over in international. The fixed income is actually spot on target, and we're just slightly underweight to real estate. And we do have a little bit of a cash position. But when you look at each of those numbers, less than 1.5% deviation from the target. So no need to do any rebalancing. Everything looks good. The only thing that I will point out relative to real estate, we are underweight and we're in the process of redeeming that investment. So each quarter we're getting some type of payment. Some quarters it's smaller than others, but it is naturally drawing down. So for the meeting today, we are going to begin the conversation about looking at the replacement for JP Morgan. It will take some time to get all of that money out, but we don't want to wait and be too far underweight. So we want to get that conversation going so that we can kind of work toward building back toward that target weight.
Hey, are we holding that money in cash as it gets redeemed?
So yeah, it would be on a short-term basis. It would be coming into cash. Typically. Every so often the city will say, hey, we need 500,000 or something like that for payments. So, as that money is going into cash and then sitting there, if the city were to say we need to pull money for payments, then it obviously would come out of there. In previous times, if we didn't have the cash and the city said, hey, we need 500,000 or whatever that number was, then we'd have to go to the equity portfolios or the fixed portfolios and raise the cash so that it could be moved over. Yep. All right, so with all of that, I'm going to keep the, what did I do?
I guess he got kicked out and he was in the waiting room. And so now she's just letting him in and putting your presentation back up. So.
I'm here, everyone. Thank you.
All right, so now I'm going to jump to page 24, and this is really the last page that I was going to draw your attention on the quarterly report, because this has all of the universe percentiles and the broader comparisons. But so I'm on the top line of page 24. For the quarter, we were up 6.56% gross of fees, behind the policy of 7.29, and we placed in the 57th percentile of the public fund universe. The next column over is the 9-month number on the fiscal year. 5.78%, spot on with the policy and sitting in the 32nd percentile. So well within the upper half of the universe. And again, when you consider, back in February, we were in negative territory. It has been a very nice recovery. Now we are not at 7.5% where we want to be for the actuarial bogey. But again, considering how far we've come in the last few months, it's certainly a positive step. And then we will have some additional updates for you that has us continuing to move in a positive direction. The only other things that I wanted to highlight really on this were a couple of the outstanding or larger items. So on page 24, you'll notice Winslow, large cap growth. They replaced Allspring and really had a fantastic quarter. They were up 20% versus the benchmark of 17.8. Now, offsetting that, of course, is Eaton Vance, our SMID manager. They were up 3.4, but their benchmark was up about 8.6. So again, contributing kind of to the underperformance. And then just really quickly on the next page, our international did really well. All the three funds combined were up over 13% for the quarter. So very strong returns with each one of them beating their respective benchmarks. Let me pause there, see if anybody has question or comment on the quarterly book. If not, I can jump into the July update. Okay. So we do have that other smaller book in front of you. Do I need to back out, or is that? While we're queuing that up on the screen, I'll just highlight on page number 1. This has a lot of market information, but what you'll notice for the month of July, the S&P 500 was up an additional 2.2%. And then obviously we have a lot of the other benchmarks there. I know there are a lot of numbers on this page, but again, just as a general statement, markets continue to move in a positive direction. And if you flip over to page 2 of the report, you will see that the fund did continue to go up, although not near as much as the benchmark. So we were up 37 basis points for the month of July, while the policy was up 90 basis points. So we were about 0.5% behind. And that brings the fiscal year to date through July to a little over 6%. So again, closer yet to that assumed rate of return. And then while we're kind of focusing on that, I ran the assets as of this morning. So we're just talking about the plan assets at the end of July being 134.68 million. We're now up to 137.2 million, which on a market value, now some of that could be contributions, it's not strictly performance, but that's an increase of about 1.9%. So again, if the majority of that is investment performance, and you add, let's just call it 1.5%, then we could be sitting right at about that 7.5% level as of today, with, call it, 3 weeks to go in the fiscal year. So again, it's not over yet, but we're continuing to move in the right direction and are getting fairly close to that actuarial bogey. But again, and getting back to page 2, again, I won't belabor this, but you can see some of the individual performance. Eaton Vance did continue to struggle for the month. Also contributing to the underperformance, Winslow. We just talked about how great a quarter they had. They were up 1.8, but the benchmark was up about 3.8. So that was contributing to the deficit in terms of the relative performance. And then we did also have some negative performance in international, which is on the next page. WCM was down about 4.5% compared to their benchmark of down about 30 basis points. So again, all of those sort of individual components sort of adding up to why we were behind by approximately 0.5% relative to the policy over the quarter and month. Let me pause there. Any additional questions on anything through July or the market value number that I mentioned?
Any questions? So we'll go ahead and do approval of that report, and then we'll move on to your presentation. Can I have a motion from the firefighter board to accept the consultant report from Mariner?
So moved. Second.
We have a motion and a second. Roll call.
George Candler,
Yes.
John McDaniel,
Yes.
Lance Hewish,
Yes.
And please,
Motion. Second.
we have a motion and a second. Roll call.
David Cohill,
Yes.
John Patridge,
Yes.
John Godstilla,
Yes.
Jason Sharp.
Yes.
And general employees.
Motion. Second.
Roll call.
Nick Curry,
Yes.
Christine Hoffman,
Yes.
Eddie Vergara.
Yes.
All boards have approved. Moving on to our presentation.
We move to the third presentation. And for hard copies now, everything is inside of your agenda packet if you want to follow along in hard copy. So the first item in order is going to be the core real estate search. So again, to reset the table, a number of quarters ago, we had recommended terminating JP Morgan Strategic Property Fund, but acknowledging that you were going to get all of that money all at once. It was going to be paid out. Now, hopefully the pace of those payments will accelerate as the market continues to move forward. But so far, they've been relatively small payments, 5%, 6%, 8% of your balance so far. As of June 30th, we still had about $4.9 million in that investment. But as that is being paid down, and as the other parts of the portfolio have been growing, we are getting a little more and more underweight to real estate. And so, considering that the time that it'll take likely to kind of review, potentially interview, and do those kind of things related to hiring a new manager, we wanted to get that conversation kind of started. So we've got a review here that includes 3 core managers that are be potential replacements for the JP Morgan kind of spot within the asset allocation.
Did JP Morgan give us a time frame when that'd be fully liquidated?
No. You get a it depends, right? I mean, if
When we sell it, we sell it.
pie in the sky, the Fed cuts this month and maybe cuts again next month or the month after, and all of a sudden you start to get a lot more movement in the real estate markets, then it's potentially, could be inside of 12 months if all of a sudden things happen quickly. But if things continue at the pace that they have been going the last couple of years, then it easily could be 24 plus months to get it, again, fully redeemed. Each quarter, they are making some kind of payment,
Right.
but it's that they haven't been huge chunks relative to, what you've asked for. So on page number 4, we've got the top line, the 3 firms that we're showing you today. First is Clarion Partners with their Lion Properties Fund. We have Stockbridge Core and Value Advisors with the Stockbridge Smart Markets Fund, and then TA Realty with their Core Property Fund. We give some kind of background information on sort of, again, what core and the real estate market is. I'm happy to go through that if you'd like me to, but otherwise, for the sake of time, I was going to skip over and just kind of get into the individual portfolios and strategies. Briefly on page number 8, you can see kind of how big these firms are, and it just so happens that by alphabetical order, they also go in order of size. So Clarion Partners is the largest with over $72 billion in assets under advisement and about 193 people within their real estate division. Stockbridge is about half that size with 130 folks in their real estate division. And then TA Realty is sitting at about $19 billion and about 65 professionals within the real estate division. I was really going to kind of skip over a couple of the next few pages. Go to page number 11. Make sure I'm looking at that. Starts to get into some of the specifics of the portfolios. So you can get a sense as to the number of properties that are held. So again, these are already existing portfolios of assets. Clarion is by far the largest with 196 properties. It's 91.4% occupied. So one of the concerns with real estate is, are you buying a bunch of vacant office buildings or something like that? And certainly you can get a sense that across the entire portfolio, it's still very heavily occupied, so generating a lot of income. Stockbridge is even better than that at 93.4%. With about 150 properties, and then TA also in that same kind of range, 91%. Bless you. And about 94 properties. Again, the TA property fund is a little bit newer and doesn't have the assets, so that tends to be why you see a smaller number of properties. That they're still relatively early on, and so they're still building up that number of properties. The other thing to highlight on the far right-hand side is the amount of leverage or debt that these companies are holding within the portfolios. And you can see each one of them is really in the mid-20s, as compared to, most folks are buying a home mortgage, you're putting down 20% and borrowing 80%. In these type of funds, you're typically putting down around 75% and borrowing 25%, at least on average across the portfolio. So a lot less debt as compared to what most folks do personally. The next page, page 12, just kind of gets into the fund. Now, you will say each one of them has a stated minimum. Clarion says it's 10 million. We've already checked with them, and they certainly would accept a smaller investment than that. Again, the redemption terms, these are going to be very similar from whether it be the JP Morgan fund or others. They tend to be quarterly with some notice period, either 45, 90 days, sometimes they're 30 days. But again, these are relatively illiquid investments. And then we also highlight the management fees. You can see Clarion has a tiered schedule, but we'd stay in that top tier, so their fee is 1.1%. Stockbridge is 95 basis points, so a little bit lower, and then TA is kind of in the middle, right at a flat 1%. So again, for each of those, we'd be in the top tier. We wouldn't be putting enough in there, obviously, to receive any of those breakpoints. One thing that gets a lot of discussion, in particular with what's happened over the last 5 years, is the types of portfolios or the types of properties these funds are owning. So on page 14, we kind of give a breakdown of how much of each segment they have within their portfolio. And so the one that really gets the most attention is that yellow band for office. And you'll see, so on the far right, the NFI Odyssey has about 16% of the index is in office. And also, maybe I should just take a half a second to explain. In the equity markets, we have the S&P 500. That it's that blend of stocks, and then managers can overweight and underweight. The Odyssey index is really just the average of all of the managers that follow the rules that the index. If their leverage is between 20 and 30%, and they're diversified across the main areas, retail, office, industrial, then you qualify to be an Odyssey. So the index is really just the average of that group of funds. Okay. But what you'll notice is each of these three, in particular, in office, is underweight. Clarion has the largest weighting at 10%, but Stockbridge is at 7%, TA is at 5%. So a lot of folks are interested, what is their office exposure relative to the benchmark or relative to the market? What is their industrial exposure and so on? And so you can see some of those nuanced differences in terms of how they're allocating their portfolio and where they presumably see the most opportunity going forward. We do have additional, kind of breakdown information on 15 and 16, where 15 gets into the geographic allocation. Obviously, you can see that the smallest portion of these portfolios is the Midwest. These core portfolios tend to be in the what we call gateway markets. They tend to be on the coasts, whether it be New York or Los Angeles, San Francisco, but certainly, Dallas, Atlanta, the other major metropolitan centers are where you're going to find the vast majority of these type of properties, just like you did with JP Morgan. And then on the next page, again, similar to that, it just sort of breaks down particularly like gateway markets versus secondary and other markets. But again, these three different portfolios are substantially similar to each other. There's no huge deviation. One of the on page 17 now, we call it property life cycle. So now again, these are core funds, which means the vast majority of their assets have to be well established Class A property that's leased for the long term, right? You're not buying vacant, empty properties. You don't have significant development projects. Now, each of these funds will allow some of that. And so what you'll see, that would fall into either the value add or the development categories. So each of these funds have, up to 10 to 12% in those non-core strategies. But the vast majority of the assets are, again, stabilized, long leased, income generating properties. It's not speculative. We're not trying to make an outsized rate of return on a development that won't see any money for 5 years. But just wanted to give you a sense that each of these portfolios does have a little bit of that, but the vast majority is the stabilized income generating assets. And then on page 18, we've got the kind of the size of the portfolios that they're buying, or the buildings that they're buying. Clarion by far has the largest in the 100 plus. That also stands to reason they're a much larger firm with more assets to manage. If you're buying, $30 and $40 million properties, you have to buy a lot more of them to deploy all that capital. So you will tend to see that as funds get larger and larger, they tend to buy larger properties. 19 and 20. 19 gets into just the age of the properties. So if you're curious about how much of the portfolio is less than 20 years old, or excuse me, over 20 years old or newer, you can kind of see those breakdowns, but they're not dramatically different from one portfolio to the next. And then one of the other questions we get, page number 20, gets into lease expiration. So if you have a core property today, but 50% of your tenants are the leases rolling next year, there's a lot of risk, right? What if you can't get the same type of rents, or what if they decide to leave? And so what we show out is the next 5 years worth of kind of those lease rolls, and you can see none of them, this year less than 10%. You've got Stockbridge, which gets to 13% of their portfolio next year, but it's all relatively moderate. You don't have all of a sudden 50 or 60% in a given year, which would obviously present some timing risk, because you never know exactly what the market is going to bear in any given year. So if you have an unusually large amount of lease expiration at one time, that could be a concern. All right, so that's it for the kind of the portfolio comparison information. I'm going to turn to page 22 very briefly and just highlight the differences in the income return. Again, these are, just like JP Morgan, kind of stabilized portfolios, primarily income generation plus a little bit of capital appreciation. So you can see each of these portfolios is ranging in the kind of the upper 3% to low to mid 4% in income. So again, when you think about interest rates where they are, our bonds are paying somewhere in the 4.5% range. So the real estate portfolios are right in that same range. So you're kind of getting a comparable level of income with, of course, the appreciation potential if you get underlying increases in value. And then I'll jump to page 24, and you can get some of the trailing. We have the calendar year on page 23. I'll skip to page 24. You can see the trailing performance. Now, again, for the last 3 years, each of these portfolios is negative. So none of them escaped, some of what happened to real estate when interest rates really went higher. But on a go-forward basis, certainly expecting better returns, especially if we do get some interest rate cuts, and that leads to some additional kind of real estate activity. Let me pause there. I know I threw a lot at you. Anybody have questions? Anybody have comments?
Brendan, I'm just curious, if you look at that page 14 where it says property type allocation, what is other? So Clarion is 14%. is in other?
Well, oftentimes that will include senior and self-storage and some of those other things, but we have those broken out separately, so it's not including those. Life sciences sometimes gets broken out as other, which is it's kind of a type of office, but it tends to be like medical office.
Okay.
Though that won't get included in the what we call traditional office, so that can be a big part. And that actually has been a growing area for a lot of the managers, where it's more kind of mission critical office. It's not just a general office building, but one that's tied to like laboratory work, hospitals, research facilities, things like that. That's a bigger part. But in terms of what else is included, I'd have to look that up and get back to you.
Thank you.
While we're still on page 14, as we went through that, Stockbridge seemed like the consistently better performer. I noticed on page 14, retail makes up 20% of their portfolio. Retail risk or risk given a big economy could be wrong, or is retail considered a plus?
It certainly can be a risk, but it also can be a plus. It has been an area that's sort of underperformed. In addition to that, you have to get into the specifics of what type of retail. Could that be more traditional enclosed shopping malls? Is that all grocery anchored, kind of strip centers, which tends to be where the majority of that ownership is, but some of them do have a little bit of mall exposure. Or could some of that be sort of, dual use? Sometimes you see, like apartments on the top 4 or 5 levels and then retail along the bottom. Sometimes they include some things like that. So you need to look at that, even in more detail, or if you'd be interviewing any of them, sort of asking some of those kind of questions. And, I don't have that information, but is that an area that's growing or shrinking? It's one thing to see 20% in retail, but if it was 30 and then they say we're on our way to 15, that tells you something. Or it's 3 years ago we were at 10 and we're right now we're trying to get to 25 because we see a ton of opportunity, and this is what we're doing. We're looking at, grocery anchor retail or whatever it might be. That can be very helpful as a part of that process. I don't have that information on the top of my head, but that's helpful to look at as we're having some of those conversations. Sure. Yes. They do. Yeah. You 10 years ago that there was really very little of that within kind of the core Odyssey market, but you're starting to see a little bit more. Now, again, many of them don't necessarily fall in the what I call traditional kind of core bucket. They may fall more into the value add or other areas because you tend to have, depending on the structure of it, sort of like lower lease terms or shorter lease terms, things like that. Right. Right. But self-storage is another one that a lot of Odyssey funds didn't own 15 years ago, but they've started to try to diversify their income streams a little bit. Again, you're not, in order to be an Odyssey qualified fund, you can't be in 50% self-storage and senior housing, but they're trying to kind of diversify somewhat into those other areas. I see it. I see the possibility of that ticking up slightly, continuing to increase. But you're not going to wake up 5 years from now and see it 25%. But it wouldn't surprise me at all to see it at 4 or 5. Yeah. Any additional questions? So again, just to kind of go back, that this is meant to kind of grease the wheels, get us starting to think about looking at picking a replacement for JP Morgan. We do have some time. So it's not like you have to make a decision today, but if you felt so inclined, we potentially could, set a time, whether that be 3-4 months from now, whether it's your next meeting or you do a special meeting if you're interested in hearing some presentations and kind of taking that next step to learn a little bit more about the portfolios. Or certainly we could kind of continue to hold off. Again, we're not all of a sudden finding ourselves at 1% allocation way underweight. We're only under by a little over 1%, but I just thought it'd be good to kind of start thinking about that and begin that process of looking for that replacement.
I think it's a good idea to present it or have them present to us, if that's possible, whether it's by Zoom or whoever it is, but at the next meeting. Like you said, I don't think it's a rush, but it'd be good to, like you said, get it moving.
Do all three of these allow us to buy in over time as we get the money from JP Morgan, or do we have to do it in one lump sum?
We'd have to massage it a little bit, put it that way. So now, each of these investments, just like JP Morgan, you make a commitment, right? $2 million, $5 million, $10 million, whatever it is. So you sign for that, but you don't send them the check. You sign the commitment, and then when they're ready for the money, they will ask for it. Sometimes it's all of the money that you've committed, and sometimes it's a percentage. So it's hard to know. So like if, I'll just use a nice round number. We're talking about $5 million. Let's say by the time we're really making a decision 3-4 months from now, potentially, we're sitting at a $1.5 to $2 million gap. Then maybe we allocate $2.5 million or commit $2.5 million, right? Because they might call that within the first 3 months. It might take 6 months or 9 months. We don't exactly know. But if they call it quickly, then we're okay because we haven't overcommitted. And then if all of a sudden JP Morgan sends us a nice large chunk and really goes down, then we would just have to go back and add to the commitment. So maybe add another $2.5 million or whatever it would get us back to that target. So there is a little bit of a massaging that would need to happen. But that's another thing that we would ask them, when they're here. What does your call schedule look like? At least, as of today. Obviously, 3 months from now, 6 months from now, they don't exactly know what it'll be, but they have a general sense as to what their activity level looks like. And then how much flexibility do they have, to just add to the commitment? Or there are some of them, again, this is not a unique circumstance where they're being hired to replace a manager who has not fully redeemed. And some of them have said, we'll give flexibility. So if you commit $5 million and we're ready for it, but you only have 2.5, just tell us, send us the 2.5, and we'll kind of rewrite and just call for the remainder later. But that's a conversation to have with each one of them, and see how they would handle it.
Are we required to take this real estate money and invest it back in real estate?
No. The investment policy currently has an allocation to real estate. So it's sort of designated, but there's nothing within the ordinance or state law that requires us to have real estate. So certainly an option could be to decide that instead of reinvesting in real estate, we'd rather just put this money in fixed income. Okay. With our, but to take that back sort of full circle, within our ordinance, we're sort of capped with equity, and we're reasonably close to that cap. And we have real estate that's allowed. So if we don't invest in real estate, it's difficult. You can't really add that to the equity bucket. So in a way, it either has to go to alternatives, non-equity, or fixed income. Okay. So again, it doesn't necessarily have to be direct, but just by the way the ordinance is structured with the equity cap, it kind of, if you don't put it in real estate, it would kind of force you to keep it in either alternatives or fixed income because we don't really have the room to add to equity.
Right. Brendan, how are the fees basically calculated right now at Wells Fargo? And then also if we say we do commit so much to one of these companies, are the fees going to be based on the committed money or the money we actually give them?
No, it's money that's not actually given.
So what about Wells Fargo? We're trying to get out of it. How are the fees calculated?
JP Morgan,
Or, I'm sorry, JP Morgan.
it's on your asset value on the balance. So as they're paying you out, it's the percentage against the balance. So as the balance shrinks, the amount you're paying them shrinks, but it's still the same kind of percentage.
Okay.
That is a good point. We are going to have a little bit of a discussion related to private equity later. A lot of those other alternative assets, in many instances, they will charge on the commitment, not on the investment that's actually put to work so far. So that is a kind of a good point. That doesn't relate specifically to real estate, but it is important to understand that there are investments that will charge fees based on what you commit, whether you've sent them any money or not. So in terms of, heard a few comments about liking the idea of having some presentations. Do you like the idea of hearing from all three? You want to narrow it to two of them? What do we think? And then I guess the follow-up question at the regular quarterly meeting, which remind me what the date is. November 18th. Or would you rather have this on a separate meeting?
Regular. Personally.
Typically, our November meeting is not
A long one.
heavy meeting, so that would be a good time.
Everybody good with all three?
Really quick, Clarion doesn't look like they have a strong track record. I was trying to find JP Morgan's track to see if they were even any better.
I had the same reaction, John, as I was going through the three. It seemed
Yeah,
like
this
Clarion
is-
was always on the bottom of the heap, and the other two better.
Where did I put the June 30 book?
Yeah, and part of it too can be what's not in here necessarily. Obviously, past performance is part of it. But like one of the issues we were having with JP Morgan was about like lack of execution on the strategy. So one of the things that JP Morgan had said 3-4 years ago, they were pretty heavy in office, as many managers were. And had indicated, they said, well, we really want to reduce our office exposure. We see a lot of risk there. And as we continue to watch them over the subsequent 2 and 3 years, the portfolio didn't really change. They stayed in office. While other managers who said, hey, we're at 30 or 35% office and we really want to reduce it, we want to get to 15 or 20, and they did execute on the strategy. So one of the things we were seeing is sort of a disconnect between what they were saying they were going to do and what they actually did, which kind of, in our mind, sort of forecast some issues or problems moving forward, where other strategies, so you might have had a Clarion, and again, I don't have the exact detail, they could have been heavier in office a few years ago and suffered plenty of like the downdraft, but now they've really reduced office. And so they've gone through the pain and don't have to still deal with 30+% office and can kind of move forward. And it's a more positive picture moving forward, if that makes sense.
Did you say you were able to talk Clarion down on the minimum? So, use them
Well, their stated minimum is $10 million, but they know, we talked to them about your targeted allocation size, which again, your targeted allocation puts you at about $6.5 million would be a 5% commitment. So if you were, initially talking about trying to stage in at say a 2.5, we'd have to have that conversation. We didn't talk about that level specifically. So are we kind of good with all three? Did we hear any objections there? Or do we want to shorten it?
I personally don't like Clarion. They've underperformed JP Morgan and they have the highest fee structure.
Okay.
Consensus to skip Clarion? Anybody feel strongly? Okay.
Agree.
Is there another one to add besides Clarion that's out there that's, I mean, maybe not Stockbridge or TA?
I mean, yeah, there's certainly plenty of other strategies. You've got, off the top of my head, you've got Intercontinental, you've got Principal. Let's see.
I mean, I think what you brought us with Stockbridge and TA are pretty close when you look at the metrics. If you could find one that
Size wise?
yeah, just size wise is kind of a little bit closer. Because I mean, there are differences between Stockbridge and TA, but they're not so disparate like they are with Clarion.
Were you looking for something with a drastically different property type allocation or anything in particular like that?
No, I mean, again, I think, I mean, if you held a knife to my throat, it would probably be a choice between Stockbridge and TA, and then I would just have to drill down in some of the minutia of their differences. But I think their returns, their makeup, you know, and a lot of the other, their expiration of their leases, I mean, that's a little bit of difference there, but just kind of something closer to that.
And I, you know, just for everybody's understanding too, like to get these, I did engage our real estate analyst to kind of put these names together. But what I can do, if you're okay with it, I can go back to him and say, you know, they'd like to hear from Stockbridge and TA and a third that isn't Clarion. So give me another name. Are you comfortable with that? I mean, obviously you won't know what that name is. I can send it to you. But if you'd like to hear three, or we could just hear from two. But if it sounds like you might want to hear from three, so you're comfortable with that idea of me going back to the analyst and getting a replacement for them.
Yeah, I like surprises.
Okay. That shouldn't take very long. At a minimum, I can pass that information along to Dustin, and so at least you know what that firm is, and obviously we'll have similar information as we head into any potential presentation. Okay. Any further questions on real estate? All right. Then let's go ahead and jump a few more pages within the book. So one of the other items that we had talked about last time was Euro-Pacific growth, the American funds in the international portfolio. They have been struggling in particular for the past 12 or 18 months, especially through March 31. So we brought an additional review. Sorry, I'm catching up on the electronic board. So page number 2 of that next book. Just want to highlight first, so up on the top we've got American Funds Euro-Pacific Growth. That fee is 47 basis points for that particular fund. I also included our other growth fund with WCM for kind of comparison purposes. So if you're looking at potentially replacing them, you'd want to see how they kind of fit in with the other portfolios. Then the 3 new strategies that I brought to you to compare: MFS International, Goldman Sachs, the GQG Partners, and Harding Loevner. You can see each of those portfolios is more expensive than American Funds and less than WCM. Okay. On the next page, I apologize, there's a lot of numbers, but I'm really going to try to highlight just a couple of them. Really, the very top row on page number 3, the number of holdings. So you see American Funds is about 350 different stock positions. WCM, which you currently have, was at 41, so far more concentrated. Interestingly, each MFS, Goldman Sachs, and the Harding Loevner funds all relatively similar, ranging from 67 up to about 88 positions. So more diversified compared to WCM, but more concentrated certainly than the existing Europac fund. And then just to contrast it, the MSCI index has roughly 1,100 stocks within the benchmark. I'm going to skip ahead to page number 5. So I apologize. There's a lot going on in these pages, but I really like the chart up on the top, either on the left hand or right hand side. Sorry, it's the kind of has a bubble chart and a grid. So what we're looking at here is sort of the value versus growth attribution, and then also the small, mid, and large cap. And both the left and right hand side aim to show the same information. The left hand side I kind of consider the average, and on the right hand side it shows where the fund has been over the last 12 or 18 months, so you can see if it moves around. So just as an example, if I'm up in the upper right hand side, you'll see that the red triangles, which is the Goldman Sachs fund, has really moved a lot from left to right. So although they're kind of always on the right half, they're not always way up in that upper right hand corner. So they're not as kind of true growth as, say, WCM is. So you see your WCM manager, there's a little bit of movement, but they're firmly planted over on the right hand side of that page. MFS is similarly very kind of consistent with their plots, but it's just slightly to the left. Again, still well within the growth spectrum, but not as growthy as a WCM. And then Harding Loevner, again, sort of similar, slightly more toward the core space, and so on. So you can just see some little bit of variance there. And then, of course, American Funds Euro Pacific is, again, also over there to the right, but of late has been moving a little bit to the left, moving a little bit more toward the core space. Then down on page 6, you get into the individual kind of trailing returns. This is what we're used to seeing, how they've done on an annualized basis for the last 1, 3, 5, and so on. And you can see strictly from a returns perspective, WCM really stands out. Now, obviously, they're your second growth manager. They've done very, very well. Over the long term, 10 years, over 11%, where the next best manager is 8 and change, and that is MFS. Again, over the longer period, American Funds has performed well. They've outperformed the index, but again, these last, number of quarters, 15 months or so, they definitely have fallen behind.
These are net of fees.
Correct. Yep. And then on the next page, page 7, it's sort of the same information, but we just look at the individual calendar years. Again, I'm not going to walk you through that, but if by chance you were curious, you can see year to year how they've done in those individual kind of 12-month periods. The other thing that I want to draw your attention to is on page number 11. And I'll say on the upper half of page number 11, which is the last 7 years. I would prefer to look at the last 10 years, which is the bottom, but a couple of just one of them, Goldman Sachs, it doesn't have 10 years. So that's not as helpful. But I want to draw your attention to a couple things in the upper part of that page. The first one is the third line down, standard deviation. So again, this is the height of the peaks and valleys in the roller coaster. At least historically, how much is that portfolio going up and down? And so you see American Funds is at about 17.5%, which again, we're going to compare that to the number way on the far right, which is the index at about 16.5%. So slightly more volatile up and down as compared to the benchmark. Goldman Sachs is dramatically lower at 13.86%. So a lot less volatile. Now, WCM, our other manager, is at 18.8, the most volatile, right? Now, they've done that. They've been very volatile, but they've also been very strong with their performance. And then MFS is lower at 15.7, and Harding Loevner stands a little bit higher at 17.1. So again, all within a relative range, but certainly Goldman Sachs stands out as sort of the low risk strategy as part of the group. And then again, WCM is sort of that higher octane, more volatility type manager. And then the other numbers that I like to look at are the up and down capture ratios. Those are the bottom two numbers. I describe this as the offense and the defense. So the up capture ratio, when the market is going up, how much of that up move, at least historically, do they capture? And think of that as a percentage. So we'll use American funds, 104.6%. So when the market is up, they're getting 104% of that. They're going up a little bit more. But on the downside, when the market is negative, they're getting 104.6% of the down market. Okay? Now the market is up more than it's down. So having, you know, an up-down capture ratio that's fairly even is not necessarily a bad thing. But again, when you contrast it with WCM at 116 and 98, so that is a fantastic spread. Now again, that's looking backwards, but generally speaking, we like to think that hopefully they can continue to do that moving forward. MFS has a similar positive spread, but it's more on the defensive side. So it's 102 on the up and 91% on the down. And then the one that really stands out, again, Goldman Sachs, is only 88% on the way up and 64% on the way down. So when the market's going up, they're, historically speaking, they're lagging. They're falling behind. But where they really do well is when the market is negative. That's where they tend to outperform. But I always like to show this because, you know, if you pick a manager, well, I'll use WCM. You already have them, but let's say you look at the 10-year number and you're like, I really like how they've outperformed by 200 basis points. Let's go with that strategy. And then you hire them, and then in the next 12 months, the market's down 5% and they're down 7%, and you go, oh my gosh, I can't take it. They're down more than the market. Well, then we didn't really make the right decision that matched our expectation because, you know, they tend to be a more volatile manager, right? So if we're worried about that kind of outcome, then it may point us toward, say, a Goldman Sachs with a low downside capture. But conversely, if we want a manager that can keep up, we probably shouldn't go with Goldman Sachs because when the market's up, they're likely to disappoint us, right? They're not going to keep up. So I always like to make sure we kind of frame that sort of decision process around what our expectations are. So within, again, and I'm stepping back here from this particular book, within international, we have the three strategies. We have Euro-Pacific Growth and WCM. Those are kind of our two growth side managers. And then we've got the DFA value. So we kind of have both sides covered. So it's just sort of a question of, do we kind of like to have a little bit more octane and get a little bit more out of that? If we want to make a change, one option is just to stick with the existing strategy that we have with WCM. Or conversely, if we like the diversification of having a third strategy, then obviously we could pick one of the other three. Let me pause there, see if anybody has question or comment. All right. Well, hearing nothing, what I would suggest. Yeah, Euro-Pacific has been a strong manager for a good while. They've gone through a little bit of a patch, but we're not. I don't see this as sort of a long-term, decline. We could just give them a little bit more time and revisit this if necessary.
I'm looking at the track record that you put in here, year over year. And even like Goldman Sachs, who's got great long-term numbers, they've had some really crappy years in here where they, they were 72, 81. It seems like they all go through hot and cold spells. So yeah, I'm with you. I don't see a drastic difference.
Yeah. Any manager that is really making an active kind of bet at taking active positions, if they stick to their guns, they're going to go through periods where their style is out of favor. You can't avoid that. So you will see that. The question is, are those relatively limited compared to the number of years that they are generally kind of better than average? And then when you blend them all together, do they outperform? Euro-Pacific Growth has done that very nicely over an extended period of time. They just, again, have been struggling as of late. Now, this quarter, they actually did better. they were 13+%, I believe it was. So, kind of performed well, but still on a trailing 1 year or so, they're behind. But again, I don't.
Benchmark for that period. You said they're at 13%. What's the?
That was just for the quarter.
That's right, guys.
12.3, versus 13.2. Yep. But on a 1 year, it's 13.8 versus 18. So certainly have struggled. But again, longer term have done very well. But again, wanted to revisit this, look at some other options. So we at least could be in a, have a better frame of reference. One of the challenges when you just look at our quarterly book, you see an index and you see a benchmark. You see a universe and you see the benchmark, but that's really it. Here you get a little bit more of a kind of look on the standard deviations, the betas, the up-down captures. So you get a little better feel as to kind of the types of managers and what other managers are doing, in order to outperform, underperform, because sometimes, just getting better performance, you may not be worth the risk, right? So you want to make sure we understand all of that because that isn't as well captured in the comparison of our regular kind of quarterly book. So is everybody comfortable kind of holding for now? And then obviously we can continue to revisit this as needed and potentially make an adjustment if necessary. Okay. All right. Then the last item on the agenda is a quick review of the asset allocation. If you recall, a few meetings ago, we did make a slight adjustment. Actually, I'm sorry, there are 2 items left. But the last kind of book-related item that's in your packet is an asset allocation that looks at private equity. So we did put in sort of a potential allocation to both private credit and private equity, although they're targeted at 0 currently in the current iteration of the policy, but there is kind of sort of a placeholder for a little bit of alternative exposure. And one of the questions came up last meeting, what could that potentially look like? And so I put together an asset allocation. And again, everything is really on page number 5. There's some supporting information before that. But page 5 has really all of the detail. So our current target weightings are in that first column on the left-hand side. And I know there's a lot of numbers, but those are all the percentages to, aggregate bonds, to large cap, to small cap, to mid cap, to fixed income, and so on, or real estate. Then down at the bottom, that allocation using the 2025 capital market assumptions project out a return. And again, these are 10 to 15 year projections, so I always have to mention that. Our policy targets are currently, with these assumptions, are targeting or projecting a 7.08% mean return with a volatility of 10.85%. Okay? So now each of the next few columns that we look at, what we want to do is compare it back to the current portfolio. So the first column over, which is labeled 2.5% PE, what that does is it actually takes 2.5% from fixed income and puts it into private equity, right? And what would that do? Is that me? So if you took 2.5% of the portfolio from fixed income, put it into private equity, it changes the expected return up to 7.25%. And the risk or the volatility goes up to 11.19%. Okay? Now the next column does the same 2.5% to private equity, but this time we're taking it from our public equity, like our large cap and mid cap, right? So that gives us still an increase in return, but less of one, which stands to reason, right? If we're expecting 8 or 9+% out of equity and 4% out of fixed income, then, if we're funding it from an 8%, we're going to get less of an increase than we would taking a 4% asset. So you can see that expected return does go up, but only to 7.17%. But you'll notice the risk actually goes down a couple of basis points. So smaller increase in return, but actually a decrease, albeit slight, in volatility. Then the next two columns are just meant to illustrate, sometimes what happens when you continue to add an asset class is any potential benefit you see at a lower level begins to go away, with additional risk. Because the way correlations work, sometimes you can get kind of a diminishing benefit. So I just wanted to take another 2.5% to make that illustration. The first one is taking all of it from public market equity. So if you took 5% of public market equity and put it into private, you get up to 7.25, and the volatility again continues to go down to 10.78. Then the last column is what if we did 5%, but we took 2.5 from equity and 2.5 from fixed, which is essentially a combination of the second and third columns, and you get a 7.34 with a volatility of 11.17. So again, just kind of giving you a few different variations on that, but you can see in each of the scenarios, you're getting an increase in return, and depending where you're funding it from, you get a potential either decrease, albeit slight, in volatility, or a pickup in volatility if it were to come from fixed income. The challenge, again, if we were to fund it something like this from fixed income, when you combine private and public equity, we get closer to that cap that's within our ordinance. Because it doesn't define public market equity, it's just equity. So private equity and public equity would be combined, I think, to apply toward that cap. So with that, any questions on what's shown here?
I mean, when you're just looking at these numbers, it seems pretty good, right? Moving from 7.08, if you went to from 5% into public equity, you're going from 7.08 to 7.25, and you're reducing risk on the standard deviation. That seems like a no-brainer. What are the downsides of public equity that's not shown here?
For private equity? Yes, so good question. One thing is the money is locked up. Most of these investments are 10-year vehicles. So you make a commitment, and for the first 3 or 4 years, they're calling that money in slowly. And you can't raise your hand and say, I'd like my money back. You pretty much wait for them to send it back. And they're making distributions as you go. Years 5, 6, 7 tends to be when you get a lot of your money back, hopefully plus a lot extra, income. And then by year 10, maybe year 11, you're kind of at the tail, and that fund is kind of wrapping up and closing. One of the other challenges they present is the valuations for these portfolios are much slower. With your traditional equity portfolio, you've got it custodied at Salem Trust. By the 15th of the next month, we have the statement, right? You know what the value is. Doing your audit is relatively easy. We have that information. A lot of these funds can be, 60, if not 90 plus days later for getting your statements. And so, that's September 30th, the end of the fiscal year. If you're not getting that value or that statement until the 1st of January, maybe even into January, that can present challenges for the audit and some other things. So that doesn't show up in an asset allocation, but those are often kind of some complaints that administrators, cities will have, is that it can cause some difficulties with things like audits and that sort of thing.
Yeah, Brendan, to your first point, the subscription, the defined length of those funds. I was at an industry conference in June, and I ran into a couple doing my own research, and there are 2 that have evergreen funds now. It's becoming more popular as they reach down more to the retail market.
Right.
The 2 that I got introduced to was KKR and TPG, 2 of the largest private equity firms in the U.S. I'm sure you guys are familiar with them, but they looked fantastic to me.
I'm curious, do you know what the minimum investment was for either of them?
They were available to retail clients. I believe KKR was an accredited investor. TPG might have been QP, but I mean, that means,
That's
that means,
relatively small.
yeah, 1 million to 5 million.
In most, what you tend to find kind of in the private equity, private credit world is that the really large companies, the KKRs, the Apollos, those kind of things, oftentimes you have to make a commitment of 20, 25, 50 million dollars. So for most plans of anywhere near your size, they're not really, haven't been a viable option. But we are seeing the industry change. One of the things you just mentioned, evergreen funds. So the traditional structure is kind of this 10-year sort of lockup fund. About 3-4 years ago, within the private credit side, we started to see more of the evergreen funds. So the private credits traditionally are the same type of structure. They might be an 8-year fund versus a 10-year fund, but the same general idea. We call them closed-end vehicles. But evergreens are open-ended vehicles, not too dissimilar from the way the real estate funds operate. So the idea is you make a commitment, you get called in, and you can let your money just stay in there, continue to roll over, and then after 2 years or 10 years or 30 years, you raise your hand and you say, I'd like to be out now, and then they pay you out over some period of time. But it's a way, one of the challenges for plans that use closed-end vehicles, you make a commitment, $5 million. They call it in. At some point, it goes up to $6 or $7 million of value, but it's only there for about 6 months. Then they start paying you distributions, and you find yourself in a couple of years, you only have $3 million in there, but you want it to be at 5 or 6. So then you kind of have to make another commitment, and you work up, and then it gets paid out, and you work up, and you get paid out. So one of the advantages of Evergreen, if you continue to like the firm and like the process, you can get into a vehicle where you ramp up, and then it tends to stay there. And you don't have to go through the process of hiring a new manager and the like. To your point, we are starting, for the last 3-4 years, we've seen that more in private credit, but we're now starting to see it on the private equity side. And I imagine 5 years from now, it'll be a significantly larger number than it is today. It's a relatively slow process, but yes, we are seeing that, and that's one of the potential benefits to those type of structures. So again, this is just meant to be sort of a high level, what potentially this kind of introducing this asset class could do in terms of a return. We haven't even gotten into sort of the asset class kind of information. We could do some education more specifically on it. And there's obviously a lot more that we potentially could discuss, but at this point, we just wanted to kind of look at what kind of the potential we're talking about, could be in terms of impact. I mean, obviously, you'd love to add an asset class and then have the return go from 7 to 10%. Overall, obviously we're not seeing any that type of impact, but it certainly is a positive impact on expected return with, again, varying impact to risk.
Yeah, I see the positive impact, reducing risk, increasing return. The details we need to work out, but I'd like to see some, like we did with the real estate funds. Let's start exploring this space.
Okay. Everybody kind of comfortable with that? Getting some additional information and taking a look? Okay.
I think we definitely have involved some administration on this. Just given what you said about the audit and things like that as well. I mean, much rather have plan sponsor buy-in on the front end of something like this.
I think that would be helpful. Because it is a different type of animal. With real estate, now that is certainly slower in valuation than the traditional equity and fixed income portfolios, but it's really only about 30 or 40 days versus 15. So it doesn't really get into any sort of issues with audits and everything else. But when you get into the privates that can be 90 plus days, it's a little bit of a different ballpark. So
this vehicle all falls within the IPS that it's currently written, correct?
Yes.
Okay.
And I guess in a way, what's more important is sort of the ordinance. The ordinance allows, there is not a prohibition against, investments. And again, in the current IPS, we're targeted at 0, but we did sort of carve out a potential up to 2.5 is sort of what it had the last time we changed it, what did that look like? And to be honest, we can re-review that because we do have the IPS on the agenda, not for alternatives, but for another reason. But we can kind of take a half a second to look at that as we go down.
I just wanted to make sure, and I know that it's been looked at quite a time ago, especially with Pedro.
Right.
This fell under the scope of the IPS. We wouldn't be really
Correct.
okay.
And that when we made the last change, it was to kind of sort of begin that process to sort of incorporate it, but again, without targeting and making any decisions. Obviously, you're not going to just find yourself in private equity just because it's written in the IPS. It's obviously an active decision, but we did kind of break out that little piece. And I guess to be helpful, why don't we just go ahead and jump a couple more pages and go to page 2 of the IPS, if that's all right. Oh, is it that on a separate?
It's in the books, but it's not on.
Okay, sorry, we don't have it up on the screen, but if you just turn a couple more pages from the asset allocation, you see page 2 of 11. You do see up in the upper category.
You guys hear me?
Yes, sort of. Did you have a comment, Pedro?
I don't know what happened to the. We've been having some internet issues.
Hello? Testing?
Mr. Roboto.
Is the router about 100 yards offshore or something?
Probably.
He went out yesterday.
Well, right. While he's trying to get set back up, I'll just again draw your attention to page number 2. So you see within the upper part of that table, we have alternative equity at 2.5%. So there is sort of that potential there in the current policy. But the way we wrote it is if you don't make an active decision, it sort of just defaults back to the 60%. So that 50%. So that 2.5 really resides up at domestic equity because we've taken no action. But we do kind of have that 2.5%. And similarly down, we have alternative fixed income, same kind of 2.5%. But the little bit of the footnote underneath it says it just reverts back to fixed income when it's not funded. So we do have sort of that allocation kind of carved out, if you will, within the IPS. But Len, if I can, I'm going to take you ahead a couple pages to page number 6. This is actually why we have the IPS in front of you. And if Pedro could join in, I'm sure he'd have a comment or two. But recently a law was passed relating to securities that engage in a boycott of Israel. And the short version is we are not allowed to own companies that engage in any kind of boycott related to Israel. Back in 2010, a very similar law was enacted regarding scrutinized companies. These were primarily companies that were doing business with Sudan and Iran. And so the process, and this has been in place now for 15 years, the state publishes a list of companies that we're not allowed to own. So kind of in the background, when that list gets updated, we take the list of securities, we go to each of the managers, confirm that they don't own it, or if they do, that they own it in a way that's legally compliant. I can walk through that if we want. But ultimately, there's a process in place that we have to go through to either make sure we're okay to continue to own it or that they sell it, right? This new law that just recently became effective essentially adds a subgroup to that scrutinized list involving companies that engage in a boycott of Israel. And so this couple of sentences on the bottom of page 6 just really references that new statute, the new law that we need to be in compliance with. But practically speaking, nothing is going to change. We're going to continue to follow the process. We're just going to have a new subset of that list. But just to give you an idea of what that looks like, Unilever, they're kind of the Procter and Gamble of Europe. They own Ben and Jerry's ice cream. Ben and Jerry's ice cream has engaged in a boycott related to Israel. So at least in the first sort of iteration, they're on this list. So we'll have to see how that plays out. 15 years ago, when we did this with the scrutinized companies, things like Royal Dutch Shell gasoline was on the list. Then a year later, they made some changes and got removed from the list. So we'll see how this all plays out. But as a public entity in Florida, we have to comply with the law. So we want to add this new provision to the IPS to just essentially, if anybody were to ask or the state would challenge it, we say, no, we actually legally, codified that in the investment policy. So happy to take questions related to that addition, but otherwise we would need to approve the IPS by motion for it to become effective.
Any questions? Anybody? So do we need to approve the IPS as amended? Is that how we need to state it? What does the motion need to be?
I would love to answer.
Yeah, I mean, I think that's sufficient because it's amended in front of you. So, or, to approve the IPS as presented.
Can you call him and put him on speaker?
Maybe.
I'm gonna type it in the chat.
Is there a number I can call in? He just.
I got him right here.
Can you hear us, Pedro? Nope.
I guess not. He's got it down, ignoring down.
We're like cavemen here trying to.
Hey, Pedro. We had a quick question about the investment policy and what the actual motion should be. If it should be approve the investment policy as amended, or because in the actual, I provided a clean copy and an edited version that's showing the highlighted changes. So what should the actual motion on that be?
So can you guys hear me? Or do you want me to talk through the mic on the Teams?
Well, that's not working. I don't think so. It's coming through very glitchy. So I'm just kind of holding you up to the microphone in here, so it's on the record.
No worries. So that, I would say that the motion would be to approve the investment policy statement as revised and discussed by the board.
Okay.
Would that work for everybody?
That
So
sounds good.
the recommended motion is to approve the investment policy statement as revised and presented to the board. Did I hear that correctly? Yep.
Yes.
Please, board. Would you like to make that motion?
Motion. Second.
Motion and second. Madam Clerk, roll call.
David Cohill,
Yes.
John Patridge,
Yes.
John Gutstella,
Yes.
Jason Sharp.
Yes.
General employees.
Motion. Second.
Roll call.
Nick Curry,
Yes.
Christine Huffman,
Yes.
Eddie Vergara.
Yes.
Firefighters.
Motion to approve the investment policy statement as we've just discussed.
Second,
Roll call.
George Cantler,
yes.
John McDaniel,
Yes.
Lance Hewish.
Yes.
Motion passes all three boards. And then we have the placeholder item D. Anything? Or sorry, did you have anything else?
Nope. That
Okay.
was just going to say that is everything that I had for you, unless you have any other questions.
Any other questions or comments for Brendan?
Thank
You
you.
really carried this meeting. Well done. Dustin, your turn.
All right. On to securities litigation portfolio monitoring. I performed a review and evaluation of the three recommended firms by Sugar and Susskind, and we're just going to go through my memo here, the different categories I looked at, and what the differences in the firms are. On the core services offered, all three firms, they use different terminology. They really do the same thing of securities litigation monitoring, providing us with reporting and evaluations of ongoing cases. And experience and track record, Wolf Popper, obviously founded and been around the longest, but as I understand it, is probably the smallest of the three firms. Technology, all firms have proprietary software that they use for their monitoring systems, and they have all the necessary cyber security compliance that we would recommend. Fee structure, we kind of talked about that before, that there's really no fee associated directly that we would be paying. They would be getting a portion of any claims that they won through court, and those fee structures would most likely be set by a judge. So really it's not up to us or them. Conflicts of interest and independence, I'll just kind of read through some of this. All three firms exclusively represent plaintiffs, ensuring no conflicts of interest from corporate defense clients. Each firm is independently owned with no investments firm affiliations. And then also had at the mayor's request, had the city attorney do a review, and I'll just read his statement. He said there's no legal conflicts of interest were identified that would preclude engagement with any of the three firms. The city attorney also confirmed that none of the firms currently represent the city in any other matters, and no active litigation exists between the city and these vendors. This clears the way for any of the three to be considered impartially. So no stops there, no issues there. All three firms have a good reputation, and like I said before, they comply with all our security requirements. So up to this point, they're all three pretty much the same. So to find some differences, Wolf Popper, like I said, is probably what they call boutique scale, so they're a little bit smaller, but the good thing about them is they have existing Florida clients that are our size, and they have a good relationship with the FPPTA and especially our current custodian, Salem Trust. They actually have a very close relationship with them, and have Salem Trust allows them to access their system without going through us. So whereas with some of these other providers, we may have to get a statement from Salem Trust, and then it comes to me, and then I have to send it to these whatever the other clients, so that they know what funds we purchased and what we own. The Wolf Popper can actually go straight into Salem Trust, and with our permission, see exactly what we purchased and when. So it's a little bit quicker of a turnaround, less bureaucratic kind of stuff. Just a simpler process for them. So that's definitely a plus for them, I would say. Saxena White is headquartered here in Florida, so that's obviously something that's a positive, and we kind of look for. We like to do business with other Florida businesses, and they also serve many other clients that are municipal and around our size investments. So that leads me to really is like a 1A and 1B kind of situation for these two, Wolf Popper and Saxena White. Grant and Eisenhofer, they're really focused on the international funds, in which we don't have a significant portion of our funds in international. So that was definitely a clear third for me, and we would definitely be at the lower end of their portfolio size that they're used to dealing with. They're not really someone who's going to come and do many presentations. Not that that's something we ask of people very often, but yeah. So I definitely recommend it here at the end. Wolf Popper as number one, mainly because of the close ties with the custodian, and Saxena White as number two. As we discussed before, this is not something where you have to choose any of them. It's not something where you have to choose one. You can have multiple. You can choose to do all three. But it's up to you guys.
Discussion? You got your
No,
light
I
on?
mean, I like Wolf Popper and Saxena mostly because of the focus in either Florida and domestic, as well as I think that their firms handle more funds our size. I do agree with you that Grant and Eisenhower is just, we would be a very, very small fish in their big pond, whereas the other two.
Got your light on. That's why I'm.
Yeah, they'd kind of echo some of the stuff that David just talked about. They were probably the two biggest as far as getting us into the information we needed for this. They teach a lot of the same classes at the FPTA, so it's been good for us knowledge-wise, getting to know each one of them, and they're always around. And like I said, I'm not sure I see the international presence, but I'm not sure as far as this goes that we truly need that.
Anybody else? Good. You've got your light on. Are you trying to make a motion?
No, I just like green over red. Sorry, fire.
If there's a motion to be made, I think Pedro has some, I guess, specific language for a motion if we're going to proceed with one whenever we're ready for that.
Does everybody feel like we're ready for a motion? All right, let's go.
Go ahead, Pedro.
Okay, so I think if the board's comfortable, the motion would be to authorize the engagement of and insert name or names plural. Authorize the engagement of name law firm for portfolio monitoring services, subject to final legal approval of the engagement letter.
Did anybody get that well enough to make the motion?
And then assuming that one of those that motion does pass, then I think we can just, by board consensus, I don't think you need a second motion, but it would just be, authorizing each respective chair to execute the agreement once we provide the go ahead, and then authorizing Dustin to work with each of the firms and the custodial bank, and just putting them together and providing access to the portfolio.
Thanks for keeping it simple for us, Pedro. Did you
the
get that
first- I
enough
got the
to make?
first half.
Okay, I'm going to throw it to Cohel to make a motion or give it a go.
I make a motion to authorize the engagement of Wolf Popper and Saxena White for the portfolio monitoring service, subject to final legal approval.
Look at that. Perfect.
Second.
Well done. We have a motion and a second. Can we have a roll call for please, board?
David Cohill,
Yes.
John Patrick,
Yes.
John Gutzstilla,
Yes.
Jason Sharp.
Yes.
Fire, all you have to do is say so moved. Anybody?
So moved.
Second.
Motion and second roll call.
George Candler,
Yep.
John McDaniel,
Yes.
Lance Hewish.
Yes.
General employees.
Motion. Second.
Roll call.
Nick Curry,
Yes.
Christine Hoffman,
Yes.
Eddie Vergara.
Yes.
And then I think there was a second part of authorizing.
Can you say that part again,
Board
Pedro?
chairs.
The second motion.
Yeah, just so again, if you want to make a motion, that's fine. But I think just the direction would be to authorize each chair to execute the engagement letter once we give the blessing, once legal approves, and you, Dustin, or whomever as the administrator, to put each of the firms in contact and direct the custodial bank to provide access to each of the firms.
I don't know that we need a motion. I mean, the chairs don't execute. an engagement letter, do they?
That's, I think, what the motion would be, authorizing the chairs to execute the letter. Otherwise, I would have to bring it back at the next meeting for the boards to approve.
Okay. You got that?
Sure, I make a motion to allow the police board or the board chairs to engage, sign the letter once it receives final legal approval.
That sound good, Pedro?
Yes, ma'am.
All right. Do we have a second from the police board? Motion and a second. Roll call.
David Cohill,
Yes.
John Patrick,
Yes.
John Gottstilla,
Yes.
Jason Sharp.
Yes.
Firefighters?
So moved.
Second.
Roll call.
George Candler,
Yes.
John McDaniel,
Yes.
Lance Hewish.
Yes.
General employees?
Motion. Second.
Roll call.
Nick Curry,
Yes.
Christine Hoffman,
Yes.
Eddie Vergara.
Yes.
Motion carries all three boards. Pension administrators report.
Thank you. I just wanted to let you guys know of some upcoming pension ordinance changes that are possible. Obviously, everything has to go through City Council for a pension ordinance change, but it's just through some things that were agreed upon with the FOP, and then plus some things that administration has notified me that they're going to be taking to council, I believe, next week. That we see, and I just wanted to let you guys know what potential changes are coming. The general plan will be bringing before City Council a proposal to add language to the pension ordinance allowing the purchase of up to 3 years of credited service for prior public employment or military service. This is very similar to an existing purchase possibility that exists in the police plan. There are several benefits to this, fiscal and it's mainly retention benefits and giving some sort of reward for military and prior municipal service and things. But it's a recruitment tool, and it allows us to reward employees and kind of tie them to the city a little closer by allowing them to purchase that extra time without costing the plans really anything, because the employee would be responsible for this purchase of prior service. The actuaries will come up with a dollar figure based on how much that employee makes and how much time they're actually looking to purchase. And again, there is a limit of up to 3 years, and it does have to be for prior service that someone's not currently receiving a pension for. So if you've got a military person that did their 20 years is getting a pension or something, that does not qualify for this. They have to not be currently receiving a pension for that time that they worked. There could be some one-time cost. There will be some one-time cost with this, and that's just what I just mentioned about the actuaries having to perform these calculations. It's probably, I talked with Kevin Nolke, it's going to be about $575 per calculation. So that could be a fairly significant number based on, how many people might get these calculations. But again, that's a one-time fee, and relative to the actual plant assets and stuff, it's not a huge cost. There are a couple other changes that could be coming. Backdrop interest rates moving from 3 to 3.5%, and also increasing the maximum pension benefits from 100,000 to 110. That's actually, there'd be a step program going from 110 to 111, 112. That's what's being proposed anyways. That again is focused at retention of key employees. It's, already running into situations where, maybe potentially, honestly, Evans comes to mind. As a commander that was here and could have potentially ran for chief or something, but he was topped out in his pension at 33 years, and it's like, he's losing money to stay because he's required to put in 7.95%, and he's topped out. So these kinds of changes allow us to keep, those valued employees at the end of their career that could potentially be a benefit to the city.
Dustin, is that for police and fire, or is that just police?
So everything that's being talked about is just general and police, not fire. Because we're no longer the plan sponsor for the fire plan as far as for changes like that. Any changes would need to come through the city of Jacksonville. I would recommend maybe taking them whatever happens here. And
yeah, if you could get me the information. I know they're looking at changing a cap because there's a lot of us that are going to be capped out, if not already.
Right.
And so I know that's a discussion, but now that we have to deal with Jacksonville to do stuff too,
it's just
a little weird.
We're definitely going to have to engage with the city attorney and other people on that of who it needs to go through, because it is our ordinance, but it financially impacts the city of Jacksonville, so we can't just change an ordinance impacting them and things. So both cities are going to have to get together. I think both attorneys are going to have to get together and figure out what needs to be done, as well as probably the union and other people. So, a lot of things need to happen. Moving on, the continuing education, we've got several people that are signed up for the FPPTA conference. It's going to be right here in Ponte Vedra this year. It's always a bad time of year for me, fiscal year end, so I will not be there. But if anyone's interested in going, it's a good time to go, with it being right here. We don't provide the hotel, obviously, for that one, since it's right here, but it's October. It says 5th through the 8th. It really starts on Monday the 6th. If you're interested, let me know. We've already got a few people signed up. Upcoming elections, we've got some employee elections coming up for police and fire. We offset the police plans, so I think David's position's coming up for election here for a 4-year term, and then we've got the 2 employee elected positions coming up for 2-year term for fire. Ed Dawson has said that he would not like to be considered for the next run, so the city clerk's office is going to be sending out a nomination email very soon and running those elections. Again, we don't have our next meeting until November, but the term does end here at the end of September. So they're looking to get that moving. Hopefully we can get another employee, and Mr. McDaniel thankfully is going to stay on with us. So keep that position filled. Proof of life, we still have a few outliers. Did you have something, Pedro?
No, sorry.
Okay. Proof of life, we still have a few outliers here that we're trying to collect from. I've got a couple of just stragglers who don't want to do the paperwork, and then a couple that I can't get in touch with. One in particular that lives not in the country, and I don't have a good address for. So that's one I'm thinking I'm just going to have to eventually cut off, and then they'll contact me when they're not getting there. But we're still working toward it, and I did get some clarification from Pedro on a few of the disability members that were in the police plan that we should technically be considering as retirees and not disability retirees, even though they originally went out as disability. They went through that 5-year term, and then it converted to retirees. So on October 1st, we'll be switching them over to retirees to coincide with the fiscal year end and stuff. So you'll see on my next report, it'll show 3 less retiree or 3 less disability recipients for the police plan. Next quarterly meeting is November 18th, 3 p.m. One other thing, how does the books work for you guys? The idea came up about getting tablets for the boards and having like 15 tablets, iPads or something like that. I don't know, whatever the IT deemed necessary. Is that something I got to work with administration on that? If it's something they want to do for all the boards to share jointly throughout the city, or if this would be something that the boards themselves would just purchase, or what? But is that something you guys are interested in, or do you just prefer the paper methods?
I mean, I know for us, I have to bring information back when they ask about it or whatever, what happened in the meeting type stuff, and I just reference this. If I don't have an iPad to, if it's just here for the meeting, I wouldn't be able to give them any specifics. They usually don't ask too much, but
Yeah.
when every once in a while they do, and you're like, so.
Okay. No strong opinions either way on this.
Fax, kind of like paper.
Okay. All right. That's cheaper. Well,
If I could just,
Kill trees.
we just talked about the next meeting being at 3:00, which is the normal. With the 3 real estate presentations, are you still comfortable keeping it at 3, or do you potentially want to make an adjustment earlier just to allow time? Totally fine either way, but just want to throw that out there.
I might not be able to make it from 10.
Yeah, I mean, realistically, if you give them each 20 minutes or so, that's 1 hour for that portion, and then the regular meeting after that. I just wanted to throw it out there. I didn't want to. However you want to do it, I just wanted to mention it.
I'm not sure what the Roberts rules on this are. Like, if we would need a motion to. I mean, I've changed the meeting. Obviously, this meeting changed without any motion, but
Well, you could just do it as a special meeting.
oh,
Like keep 3:00 as our regular meeting, but then add on to the front of it as a special meeting
okay.
instead of having to change, since
see.
this one's already been posted.
Mhm.
And then we'll just allocate how much time we need for that. Any other questions, comments, concerns? Motion to adjourn? Did we do that in this one? Go ahead, we'll do it for good measure. Motion to adjourn?
Sure.
Is there a second? All in favor, signify by saying aye. Any opposed? Meeting adjourned. What'd you think?